something that's both complex. Hey, it's great to have you here for this episode. Today, we're diving into something that's both complex and really important: public debt and debt crises.
Yeah, it's one of those topics that feels a bit dry at first, but when you dig in, it's actually fascinating, and it affects all of us in so many ways.
Absolutely. So, to start off, public debt is basically the money a government borrows when its tax revenues aren't enough to cover spending. It can come from inside the country, which we call internal debt, or from foreign sources, known as external debt.
Right, and internal debt is borrowing from citizens, banks, or institutions within the country, usually in the local currency. External debt, on the other hand, comes from foreign governments, international organizations like the IMF or World Bank, or foreign investors, and often in foreign currencies.
That currency difference is a big deal. Borrowing in your own currency gives the government more control and less risk from exchange rate swings.
Exactly. And governments use public debt as a fiscal tool to finance projects, cover budget gaps, or respond to emergencies. It's like taking out a loan to build a house, but on a national scale.
Speaking of loans, internal debt comes in a few forms. There are bonds, which are long-term loans with fixed interest paid periodically, and the principal repaid at maturity.
Then there are treasury bills, or T-bills, which are short-term loans sold at a discount. They don't pay regular interest, but are redeemed at face value when they mature, usually within a year.
And treasury notes fall somewhere in between. Medium-term loans with fixed interest maturing between 2 to 10 years.
What's interesting is that internal debt is generally more stable because it's in local currency. Governments don't have to worry as much about currency fluctuations increasing their debt burden.
Plus, internal debt can be a tool for monetary policy. Central banks buy or sell government bonds to influence the money supply and interest rates.
But there's a catch. If a government piles on too much internal debt, it can strain finances. They might have to raise taxes or borrow even more, which can limit spending on important services like education and health.
Yeah, it's a balancing act. Now, external debt can provide vital funds for infrastructure and development projects that boost economic growth.
But it carries risks. Since it's often in foreign currency, exchange rate fluctuations can increase the cost of repayment. If the local currency weakens, the debt becomes more expensive to service.
And heavy reliance on external debt can make countries vulnerable to economic shocks, rising interest rates, and can lower their credit ratings, making future borrowing more expensive.
So when does this borrowing become a crisis? A debt crisis happens when a country can't repay its government debt because revenues are too low for too long.
That loss of investor confidence can lead to higher borrowing costs and economic turmoil. And it's not just the country itself. Global financial markets can feel the ripple effects.
Right, and history gives us some pretty stark examples. The Great Depression, for instance, started with the 1929 U.S. stock market crash and led to massive unemployment and bank failures worldwide.
Countries abandoned the gold standard, which led to competitive devaluations and trade barriers. The U.S. responded with the New Deal, introducing reforms and social safety nets that helped recovery and shaped modern economic policy.
Then there was the international debt crisis in the 1980s. Developing countries borrowed heavily in the 1970s at low interest rates, but when U.S. interest rates rose and the dollar appreciated, many couldn't repay loans.
Mexico and Poland were among the hardest hit. The IMF stepped in to coordinate efforts, and the crisis lasted through most of the decade.
The East Asian crisis in 1997 is another example. It started in Thailand due to a fixed exchange rate and large current account deficits.
The Thai baht collapsed, and the crisis spread to Indonesia, Korea, and others, causing severe recessions. IMF bailouts came with painful austerity measures, but reforms improved financial governance.
Latin America has had its share of debt crises too. Mexico's 1994 tequila crisis and Argentina's 2001 default stand out.
Argentina's crisis was driven by fragile public debt dynamics and currency issues, leading to a deep recession and IMF intervention.
Fast forward to 2008, the Great Recession originated in the U.S. subprime mortgage crisis and spread globally.
Massive financial losses, credit freezes, and economic contraction followed. Coordinated global stimulus and central bank actions help stabilize and slowly recover the economy.
And then the European debt crisis in 2010 hit countries like Greece, Ireland, and Portugal hard.
Greece's crisis was severe: high unemployment, social distress, and massive public debt. The IMF and European partners provided bailout programs with strict fiscal adjustments.
It's sobering to think about the human impact behind these numbers: unemployment, social hardship, and economic uncertainty.
Definitely. Debt crises can cause banks to suffer losses, reduce government services, increase taxes, and lower consumption. They often lead to recessions and social hardship.
But it's not all doom and gloom. Well-managed public debt can support economic growth, and internal debt, while less risky, still requires fiscal discipline.
External debt offers growth opportunities, but exposes countries to global market risks. So it's about finding the right balance.
History shows that debt crises often stem from a mix of excessive borrowing, poor fiscal management, and external shocks.
And international institutions like the IMF play a key role in crisis management and recovery.
Fiscal discipline, transparency, and sound economic policies are essential to avoid crises.
Plus, the global economy is so interconnected that coordination and multilateralism are crucial.
Understanding public debt and its risks helps us appreciate the delicate balance governments must maintain to support growth without falling into crisis.
Well said. It's a complex topic, but one that really shapes the world we live in.
Absolutely. Thanks for exploring this with me today.
Thanks for listening, everyone. We hope this gave you some useful insights into public debt and debt crises.
Until next time.